everybody. Luke Gromen, FFTT. Hope you are well and having a great fall. It is just about the absolute peak of the leaves changing here in Cleveland, so it is absolutely gorgeous. I've been enjoying that, plus unseasonably warm weather all October. So it's been 70 to 80 degrees here in beautiful colors. So we're enjoying it. Hope you are as well. With that, I'm going to jump right in. First question is from PB. What are your thoughts on the Fed failing to sell any long-term bonds during this most recent QE taper, or quantitative tightening taper? What are the impacts of this, and what are other moves the Fed and Treasury can make to add liquidity to the system without doing the traditional QE? In my opinion, this is a case, the fact that they didn't sell long-term treasuries, or they didn't taper long-term treasuries. And you can see this, Peruvian Bull is PB. Find him on X. He has a really good thread highlighting exactly this using Fed data. In my opinion, the fact that they didn't sell long-term treasuries in this round of quantitative tightening is a case of the dog that didn't bark. What do I mean by that? I frequently hear investors say over the last several years, Luke, there's no fiscal problem, because if there was, the long end would be blowing out, and look, the long end is well behaved. Okay, it is. That's true. So why didn't the Fed sell any bonds at the long end in QT, especially while the curve was inverted? More demand at the long end than at the short end, in theory. It's the old bond market saying, feed the ducks while they're quacking. Why didn't the Fed want to feed the ducks while they were quacking for long end paper? Either, in my opinion, the Fed was too dumb to sell treasuries while the ducks were quacking at the long end while the curve was inverted, or the Fed knows that long end liquidity in the Treasury market is not very good. And, in fact, that it was so thin secularly that adding to supplies by Fed selling into the long end would have contributed or extended what we have repeatedly highlighted as Treasury market dysfunction in 3Q22, 1Q23, 3Q23. To me, it strains credulity not to think the latter explanation is the explanation for why they didn't offlay long-term treasuries while they were tightening. The implications of this, I think, are very important. We've started to see them. This would also fit in with why Yellen shifted so much issuance to the front end at the end of 2023. As we've been highlighting, more front-end issuance, all else equal, is more secularly inflationary. T-bills are more cash-like than 10-year treasuries. It would also fit in with the narrative that we've been highlighting that the biggest marginal foreign buyers of US Treasuries have been the United Kingdom, which is a twin deficit nation with a fiscal problem of its own. In other words, those are hedge funds. In all likelihood, or hot money. The number four, they're the number three, the three biggest creditors: Japan, China, UK. Number four is the Cayman Islands, population 68,000. They now own, proud owners of $419 billion of treasuries. They own about 70% as many treasuries as China does. Interesting. There too would suggest it's probably hedge funds. Would also support this more paper issued at the short end because that's where the demand is. Number five is Luxembourg. Very small country. Most Americans probably couldn't find it on a map. Tax shelter. Again, hedge funds, profit-sensitive investors, not patient central banks buying long-term paper. So the gist of it is that it's the implications that they couldn't sell more off their balance sheet at the long end is that it's secularly inflationary, and that there is a fiscal problem. Otherwise, they would have sold, because they didn't want to blow out the long end of the curve, which is the real policy rate of the real U.S. economy. They would have created a debt spiral, like we started to see occur in 3Q23. What else can they do? There's a lot of things they can do. They can regulate banks into buying more treasuries with SLR. they can weaken the dollar, all else equal, weaker dollar creates more foreign treasury demand by reducing hedging costs for treasuries. So those are some of the things they could do. We saw them do BTFP, the Bank Term Funding Program, or buy the effing paper, which was de facto QE for the banks. There's a lot of things that they can do to basically keep these plates in the air. But when you see dogs that don't bark, pay attention to them. They're telling you something, just like they told our friend Sherlock Holmes. So, next question from Chris. If new monetary system is gold as a reserve asset, and gold has to be flat or rise versus oil over time, and monetary systems typically last 40 to 80 years, and all else equal, are we saying that gold miners will have expanding margins with gold to oil ratio, gold going up flat to up versus oil as a proxy for gold miner margins for 40 to 80 years? Kind of sounds that way to me. In theory, yeah, all else equal, I agree with Chris saying it kind of sounds that way to me. Assuming that monetary transition, which is a revaluation of gold versus oil higher, and then ultimately kept at some level in a range, whether that's 100 barrels an ounce, 200 barrels an ounce, 500 barrels an ounce, I don't know where that could ultimately settle. To me, the risk to that thesis structurally makes sense. The risk to it, in my opinion, would be that with gold going back into the system as a reserve asset, will governments allow miners to keep the full economics of all of the upside of gold's price, or will there be essentially a quid pro quo whereby the first X $1,000 of gold's price accrues to the miners, every X $1,000 after that goes to the sovereign in seigniorage, since we will be dealing with a reserve asset? I don't know. That's the risk. But from a conceptual standpoint, reasonable sort of, Texas hedge proxy, if you will, of gold miner margins is the gold to oil ratio. And so if the gold to oil ratio goes a lot higher from here, all else equal, that should be good for gold miners. That's probably just the easiest way to summarize it. Then we can extrapolate as things continue from here. From S, how can we analyze an emerging market to determine which of those nations are best positioned for U.S. dollar inflation? And I would say is, okay, U.S. dollar weakness driving that inflation. Let's make that assumption. It's an interesting question. It has multiple angles. I don't have an answer, but I have a framework that I'll talk through. So, what happens to that nation's competitiveness versus U.S. markets in the U.S. if the dollar's a lot weaker? So, do they lose access to the U.S. market? Are they going to be overtaken by a U.S. firm, or are they not? Competitiveness in global markets versus U.S. firms if the dollar is a lot weaker, and that company competes against U.S. firms who make a lot of the competing product in the U.S. Their costs will be cheaper, the U.S.'s costs. What is that nation's U.S. dollar denominated debt levels? All else equal, debt service gets a lot easier with a weaker dollar. That's good for that country. What happens to that nation's assets in dollars? Do they go up a bunch as the dollar weakens? The stock market goes up a bunch. That's possible. Do they have dollar-denominated commodity exports, oil, other commodities? Do they have a lot of gold reserves that will go up a lot in dollar terms in a dollar weakness scenario? Who has industrial capacity to sell in and reshore, right? So if the dollar gets weaker, can Japan benefit from helping the U.S. reshore? If the dollar gets weaker and we're going to reshore, will we buy a bunch of stuff at first from Korea, Germany, and China? Possible. Those are the types of ways I would look at it and sort of turn the question in my mind. I don't know sort of how, when I put up that matrix of questions, what that spits out. But I think that gives at least a starting point of the matrix of how I would think about attacking the problem, and then going from there in terms of what that determines. From Alex, Will HSBC's split, East versus West, be copied by others to ease through mutual BRICS Western sovereign and corporate debt reduction? Clear, clean, cut costs, single block focused. I don't know. I thought that was a very interesting headline that HSBC is looking to split basically East and West. So we'll have to see if that happens. What I do believe, what I can say and observe is that on one side, let's say there is an economic iron curtain. It's probably too strong a phrase, but for sake of discussion. Economic iron curtain between the BRICS and the West. Okay? The majority of the world's energy production, commodity production, people, factories, creditors, and surpluses are all on the BRICS side of the economic iron curtain. The majority of the world's deficits, debt, are all on the US, Japan, EU side of the economic iron curtain. And so if we just say, okay, there's going to be an economic iron curtain, east-west, that's the message. One side of the economic iron curtain is likely going to be deflationary. The BRICS, they're going to have deflation because you're going to have a whole lot of production and people, and they're going to have to consume a lot more of their own production. They're not used to consuming that. And so you're going to need central banks effectively fighting deflation by stimulating to create domestic demand. In my opinion, one way they could do that is by bidding up gold. They own a lot of gold at the retail and bank, etc. level. The other side, the West, in that scenario would be explosively inflationary. Explosively inflationary. Because you're going to have central banks who need to replace all of the BRICS on the wrong side of the wall as creditor of these nations. So they're going to be printing money to buy sovereign debt of these countries, and they're going to need to finance the reshoring of production. And they're going to need to do that at interest rates that don't blow up the bond markets of these countries on the west side of the BRICS, BRICS West Iron Curtain, economic Iron Curtain, because as I said, most of the debt's on the west side. So central banks are going to need to print to keep the debt whole. They're going to need to print to help reshore, and they're going to need to print to keep rates at an affordable level. So that's why I say explosively inflationary in that case. So all of that discussion assumes that there is no fungibility of oil or commodities in between the two sides, and in the Cold War there was. So that muddies the waters a bit. And so that is, to be clear, that is not a, hey, straight deflation in the BRICS, straight high inflation in the West. If in an economic model where you could hive off and have no fungibility of commodities or dollars or anything going in between the two, that's what you'd have. Those will be the impulses. Then the question becomes, how do the flows of fungibility of oil, commodities, etc., muddy that a bit, and that to me is less clear. So that's how I would think about that. From Mark, could Elon Musk, as head of a Department of Government Efficiency, is something he's been tweeting about or ex-posting about, bring about any meaningful reduction in our national debt? Would Trump even be able to implement Musk's recommendations? And what, if any, effects could it have on markets? Could they do it? In theory, yes, but only if they are willing to stand aside and allow a literal Great Depression in the United States, crash the economy, crash the banking system, no bailouts for anybody. You got over 250,000 in a bank, Mr. Company, Mr. Individual, bye-bye, it's gone. We warned you. No FDIC bailout for you. That, if you take, the reason I say that, U.S. is running 5% of GDP or 8% of GDP deficit. Let's say you take 5% of GDP out of that. It means you got to take 5 points of GDP out now. You take 5 points of GDP out now, you're basically going to have a recession. Recall that a 3% annual decline in GDP is what we saw in the Great Financial Crisis. So in a recession, paradoxically, deficits go up 6 to 8 points of GDP. So if you cut enough deficits that you trigger a recession, say that number's 5%, you're immediately going to have to add back 6 to 8 points of GDP of deficit. So you're gonna cut 5 points of GDP and end up with a deficit that's higher than when you started if you trigger a recession. And this is the side of it that a few people that really I think some of the great macro minds understand this. I've seen Druckenmiller talk about it. I've seen Kirill Sokolov talk about it. I've seen others talk about that. Once you get to where we are on debt to GDP and deficit to GDP, you're too far gone. You can't cut aggressively because you end up with deficits higher as a percent of GDP than when you started because of the counter-cyclical impact. So if Trump and Musk are willing to basically stand aside and let all of it come down, new Great Depression, bank failures, deposit losses, then yeah, in theory, that is never going to happen in my opinion. So the other way they could do it is a one-time massive devaluation of the dollar, probably versus gold. They can instruct Treasury, revalue gold to say $20,000 an ounce. That would deposit $5 trillion into the Treasury general account, free and clear, no offsetting debt on the other side of the ledger. They can then take those $5 trillion, buy back a big chunk of the bond market at market value, which is down a bunch from where they issued it 3-4 years ago because rates are up. That would get debt to GDP back down to something very manageable, 50, 60%. And now, from that point, absolutely, Musk could do the Department of Government Efficiency. Would it hurt? Yes. Would it create a recession? Probably. Would that recession drive a bankruptcy, essentially, of the U.S. government and a collapse of the U.S. banking system? No, and that's the key. So it's an order of operations issue. I don't think just because it's Trump and Musk, they can do it without devaluing the dollar. And if they don't do it without devaluing the dollar a bunch first, it ain't going to work. The other way you could, in theory, do it is if Trump and Musk know about some magic, or what's functionally magic, productivity miracle thing. All right, so if it comes out, let's say he gets elected and it comes out, the UAP, the UFO thing that have been being leaked out or talked about in a number of different very serious channels is actually, by the way, we have this technology for energy that is unbelievable and better than nuclear fusion. That would do it too. That would allow them to do Department of Government Efficiency. It would create other problems on the other side. It's so efficient that you're going to need a lot fewer people working, and those people won't get breaks on their mortgages, cars, student loans, credit cards, and so you're going to have to do UBI, print the money for it. It's complicated, but that's one way. In theory, they wouldn't have to devalue the dollar if they wanted to implement devalue the dollar first if they want to implement austerity. From WWW, bond yields have been moving up since the Fed rate cut. Is this a buy the rumor, sell the news type action, or are we beginning to see the start of Treasury market dysfunction? Yes, we're seeing the start of Treasury market dysfunction, which is ultimately just a polite way of saying fiscal crisis getting acute again. There's a fiscal problem. There's too much debt. There's not enough private sector balance sheet. And any time the Fed does anything, whether that is over tighten or overstimulate, the long end starts to get spooked. Private sector balance sheet moves away from it, and you start creating Treasury market dysfunction. So we've seen this week the Treasury move volatility index is up to 130. That's where we have been when we start seeing dollar liquidity injected to ameliorate that. And so I think we're probably getting close to that. So I'm watching it very closely. I'm very interested. And then the final question from GT, is there anything that can stop gold rising above $3,000? I think it's going there. To play devil's advocate, I think if Trump gets elected, we could see gold fall a bit. Only because I think gold got sold on him winning last time. And I think that's the wrong thing to do, is sell gold on him winning. But I think tactically we could see that for a relative cup of coffee. So be aware of that. I'm not selling or changing any of my positioning. I don't care because I see the likelihood of how this end game is likely to play, which has to be, in my view, significant dollar devaluation. Uh, Secularly, if you saw some sort of geopolitical development in Russia or China that effectively forced them to stop shifting to multi-currency energy and commodity pricing with net gold settlement. So basically, you know, somehow Putin leaves and he's replaced not with a harder liner than him, but rather someone who is like Yeltsin, who basically sells Russia to the United States interests and starts selling their commodity production in dollars strictly again. That would be something that would be gold negative in my opinion. If China stops for whatever, has some sort of geopolitical issue and basically moves back into being a U.S. economic vassal where they buy treasuries at significantly negative real rates and stop stop successfully buying oil and commodities in yuan, net settled in gold, that would force me to rethink. I don't think there's any chance of that happening. And or the last would be if the U.S. is willing to do some sort of Milei Argentina-like austerity, which we just touched on, which again, without devaluing versus gold first, you would have a moment, you'd have a month or 2 months or a quarter or 2 quarters even of gold weakness as you had severe deflation, but only up to the point where it became clear that the debt levels were unsustainable and the U.S. would be on track to nominally default on its debt and entitlements. And in that case, I think there would be nothing more bullish for gold than that. So you could, in theory, if you had some sort of credible austerity program in the U.S., which I think would need to be 25 to 35% cuts to entitlements and defense immediately and permanently. That's how draconian they would have to be. If I saw a government doing that, yeah, I would probably buy puts on gold at that point. I wouldn't want to sell my gold, but I'd buy puts on it and hedge it out because that's really bearish for gold. However, the resulting economic recession from those actions, if they don't take care of the debt first, is going to quickly push U.S. interest expense above receipts. And not entitlements plus interest, just interest above receipts. And then you're done. You're done. And what I mean by you're done is now you're into the 3Q23 debt spiral. Rates up, deficit up, receipts down, deficit up, rates up, receipts down, and either print the money to pay the interest or default on the debt. Neither one's bad for gold. So that's why I say it would be for a cup of coffee. That's how I think it's important to think about those dynamics. But setting those things aside, I think gold's headed to $3,000 and higher, and certainly on a secular overtime basis. So with that, thank you for joining tonight. If you like these updates, check out FFTT's Tree Rings, 10 most interesting things. We have a special going on right now through Sunday. If you sign up for Tree Rings now, you get 4 free weeks. FFTT-treerings.com. The 10 most interesting things, brief synopsis of what grabbed our attention about them, how they are either confirming or changing a way about how we are thinking about the world, macro, etc. So thanks again for joining me. Everybody have a great rest of your week. Look forward to chatting with you soon. Take care.